Picture this. Your Bitcoin, locked away in what's marketed as one of the most secure hardware wallets in existence. Offline, untouched, sitting in a safe. Then you check your balance, and it's gone. Not stolen by a hacker who broke into your house, not phished, not tricked, just gone, vanished into thin air. That's the nightmare now unfolding for thousands of Bitcoin holders, and the losses are closing in on $90 million. Stick with me, because I'm going to walk you through exactly how this happened, and why physical gold and silver remain something no digital vault, no matter how advanced, can ever replicate. Welcome back to Currency Arc Insight, where we cut through the noise of modern finance and expose the risks the mainstream isn't talking about, so you can protect what you've built. In the final days of July 2026, something strange began appearing on blockchain trackers around the world. Security researchers noticed a pattern that did not make sense at first. Large amounts of Bitcoin were moving out of wallets that were supposed to be among the safest devices in the industry. These were not exchange accounts. These were not software wallets sitting on a phone connected to the internet. These were hardware wallets, the kind that experts had recommended for years as the gold standard of self-custody. At first, the reports were small, a cluster of addresses here, a handful of drained wallets there. But within days, the picture became much larger and much more alarming. Researchers tracking the situation, including analysts at Galaxy Research, began connecting the dots. The wallets being emptied all shared one thing in common. They were built by the same manufacturer, a company known as CoinKite, and the affected devices were part of the Cold Card product line, a brand that had built its reputation on being nearly impossible to compromise. One case in particular caught public attention. A man named Jonathan Goodman posted about his experience online, and his story spread quickly. He explained that he woke up to discover that $1.6 million in Bitcoin had vanished from his wallet. He had done everything the security community recommends. He kept his device offline. He never shared his seed phrase. He followed every rule in the self-custody playbook, and yet his funds were gone in minutes, swept away by someone he never met, using a method he never saw coming. His story was not unique. As more victims came forward, the scale of the damage grew. What began as reports of around 594 Bitcoin stolen, worth close to $38 million, kept climbing. The number passed 1,000 Bitcoin. Then it passed $75 million in total losses. By early August, the figure had climbed even higher, with estimates reaching close to $89 million stolen from thousands of separate wallets. And the unsettling part is that the situation was still unfolding. Investigators warned that the final total could end up being even larger, since new victims kept discovering their funds missing every day. What made this event so shocking to the crypto community was not just the size of the losses. It was how the theft happened. There was no phishing email tricking someone into clicking a bad link. There was no malware secretly installed on a victim's computer. There was no thief breaking into a house and stealing a physical device. Attackers never needed to touch a single wallet or interact with a single victim. Somehow, funds that were supposed to be locked away safely offline were being emptied by people who had never seen the device in person. For years, the self-custody community had preached a simple message. If you hold your own keys, if you keep your device offline, if you never share your seed phrase with anyone, your funds are safe from the outside world. Cold Card had built a strong reputation around this exact promise. It was praised repeatedly for its air-gap design, meaning the device never connected directly to the internet, which in theory made remote attacks nearly impossible. But something had gone wrong at a much deeper level, hidden far below the surface where ordinary users could never see it. The flaw was not something a user could have noticed by being careful. It was not something that better password habits or extra caution could have prevented. Whatever was happening, it pointed to a problem buried inside the technology itself, something that had been sitting quietly for years before anyone realized the danger it created. For thousands of people who believed they had done everything right, this was a devastating discovery. Trust in hardware wallets had been built on the idea that offline storage meant real safety. Now that trust was being tested in the most painful way possible, through real losses affecting real families and real-life savings. As the story continued to develop, one question became impossible to ignore. If a device this trusted, this praised, and this widely used could fail in a way nobody predicted, what did that say about the safety of digital wealth in general? That question would lead directly into an explanation of exactly how this happened. A technical flaw dating back years, hiding in plain sight, waiting to be discovered by the wrong people at the wrong time. To understand how thousands of Bitcoin wallets could be drained without a single victim clicking a bad link or losing their device, it helps to go back to the basics of how a hardware wallet is supposed to work in the first place. When someone sets up one of these devices, it generates something called a seed, which is really just a long string of words that acts as the master key to all the funds inside. The entire security of the wallet depends on one simple idea, and that seed has to be completely random, so random that no outside person could ever guess it or recreate it, even with powerful computers. This is where the trouble began. Investigators eventually traced the problem back to a firmware issue that had been sitting quietly inside certain cold card models since as far back as 2021. Firmware is the small piece of software built directly into a device that tells it how to operate. In this case, the firmware responsible for generating those supposedly random seeds was not doing its job the way everyone assumed. Instead of relying on true hardware randomness, something that is nearly impossible to predict, a flawed process was quietly narrowing the pool of possible seed combinations. In simple terms, the number of possible outcomes the device could produce was far smaller than it should have been. What looked random on the surface was, in reality, far more limited and far more guessable than any user could have known. For nearly 5 years, this weakness sat unnoticed. Owners of these devices went about their lives believing their coins were locked behind an unbreakable digital vault. They had no way of knowing that the very foundation of that vault, the randomness meant to protect them, had a crack running through it the entire time. Once someone eventually discovered this weakness, the attack became almost mechanical. A person with the right knowledge did not need to hack into anyone's computer or trick anyone into revealing a password. Instead, they could sit far away, generate large batches of possible seed combinations using the same flawed method, and calculate the private keys that would result from each one. From there, the process became a matter of checking those calculated keys against the public blockchain, which anyone in the world can view, to see which of them matched a wallet that actually held funds. Once a match was found, moving the money out was simple. Because the attacker technically held a valid private key, even though they never should have been able to obtain it, the transaction looked completely normal to the network. There was no alarm, no red flag, no way for the blockchain itself to know that something had gone wrong. As far as the system could tell, the rightful owner was simply moving their own coins. This is part of what made the situation so unsettling for people watching from the outside. The attackers never needed physical access. They never needed a phishing email. They never needed the victim to make a single mistake. The failure existed silently at the manufacturing level, waiting years for someone to notice the pattern and take advantage of it. Once security researchers understood what was happening, the response moved quickly. CoinKite issued urgent warnings to its users, especially those whose wallets had been set up using the affected firmware without additional protective steps, such as adding extra randomness manually during setup. The advice was clear and urgent. Move funds immediately to a new wallet created using corrected firmware, because there was no way to know whether a given wallet had already been identified by someone running these calculations in the background. For many owners, this was a frightening realization. It meant that simply owning a cold card device and following the standard setup process may not have been enough. The very tool they trusted to protect their wealth may have quietly exposed it years before they even realized there was a problem. This event revealed something bigger than a single company's mistake. It showed how a hidden flaw, buried deep inside code that almost nobody ever inspects personally, can sit dormant for years before causing sudden and devastating losses. It also raised an uncomfortable question for anyone relying entirely on digital systems to protect their wealth. If a flaw like this could hide undetected for half a decade inside one of the most respected wallets in the industry, what other silent risks might already exist inside the systems people trust every single day? For years, the crypto world operated on a comforting belief. If someone truly wanted to protect their wealth from hackers, banks, and outside interference, the answer was simple. Take control of the keys yourself. Store them offline. Keep the device away from the internet entirely. This idea became known as self-custody, and it was treated almost like a religion among serious investors. The logic made sense on paper. Remove the middleman, remove the exchange, remove the bank, and nothing could touch your funds but you. Cold Card built its entire reputation on this promise. It was praised again and again for what experts called an air-gap design, meaning the device was built to never directly connect to the internet. In theory, that made it nearly untouchable from a distance. No hacker sitting behind a screen somewhere could reach through the internet and grab funds sitting on a device that was never connected to begin with. For a long time, that logic held up, and millions of dollars in Bitcoin found a home inside these devices because of it. But the events of the past few weeks exposed a hard truth. A device can be perfectly designed on the outside and still carry a hidden weakness buried deep inside its code. No amount of offline storage, careful handling, or personal discipline could protect someone from a flaw that existed before they ever bought the device. The people affected by this breach did not make careless mistakes. Many of them followed every piece of advice the community had given them for years. They kept their devices offline. They avoided sharing information. They treated their wallets with the same seriousness someone might treat a locked vault. And still, it was not enough. This situation carries an uncomfortable parallel to one of the most famous disasters in history. In April of 1912, a massive ship set sail that was marketed as unsinkable. Engineers, passengers, and the public alike believed its design made disaster nearly impossible. That confidence turned out to be misplaced, and the result was one of the most devastating tragedies of its time. The lesson from that story is not that engineers were careless or that passengers were foolish. The lesson is that overwhelming confidence in a system, even one built with the best intentions, can blind people to risks hiding just beneath the surface. The same pattern now applies to digital security. A wallet can be praised by experts, trusted by thousands of users, and still contain a silent flaw that nobody notices for years. This is not unique to one company or one product. Every piece of software, no matter how advanced or well-reviewed, is written by humans, and humans make mistakes. Sometimes those mistakes are caught quickly. Sometimes they sit quietly for years, waiting for the wrong person to stumble upon them at the wrong time. This raises a bigger question that goes beyond any single wallet brand. If a respected, air-gapped offline device can be compromised through a flaw buried inside its firmware, what does that say about digital security as a whole? Every digital system, whether it is a hardware wallet, an exchange, or even a bank's internal software, depends on lines of code written by people who are not perfect. Every one of these systems carries some level of invisible risk that ordinary users have no way of detecting on their own. This does not mean self-custody is a bad idea, or that removing banks and exchanges from the equation is pointless. It simply means that self-custody trades one set of risks for another. Instead of worrying about a bank freezing an account or an exchange collapsing, the individual now carries the full weight of trusting the device, the firmware, and the random number generator built into that device. When those elements work as intended, self-custody can be incredibly powerful. But when even one of them fails silently, the consequences can be just as devastating as any bank failure or exchange collapse ever was. This is the uncomfortable truth many are now being forced to confront. Digital security, no matter how well designed, still relies entirely on code functioning exactly as intended every single time, for years on end, without a single hidden flaw slipping through. History has shown, again and again, that even the most trusted and celebrated systems can carry weaknesses nobody saw coming until it was too late. And that reality is pushing many people to ask a difficult question. If code and firmware can fail this quietly, is there a form of wealth that does not depend on any of it at all? After watching thousands of people lose their savings to a flaw hidden inside a trusted device, many investors began asking a simple but powerful question. Is there a way to hold wealth that does not depend on code, firmware, or random number generators at all? For a growing number of people, the answer points back to something humanity has trusted for thousands of years: physical gold and silver. The appeal is easy to understand once someone thinks it through. A bar of gold or coin of silver does not run on software. It does not have a firmware update. It does not generate a seed phrase that can be recreated by someone sitting far away with the right calculations. There is no private key to steal because there is no digital key at all. Ownership is decided by simple physical possession. Either someone holds the metal in their hand in a safe or in a vault, or they do not. There is no remote sweep, no silent exploit, no attacker anywhere in the world who can reach through a screen and empty a vault because of a weakness written into code years earlier. This is a different kind of security altogether. It does not rely on trusting a manufacturer to write perfect code. It does not rely on trusting that a random number generator is truly random. It relies on something much simpler: the laws of physics. Metal sitting inside a locked safe stays there unless someone physically opens that safe. That is a form of protection that has worked for thousands of years, through empires rising and falling, through wars, through currency collapses, and through every technological revolution that has come and gone. But it would be misleading to present gold and silver as some kind of perfect solution with no risk at all. That is simply not true, and anyone serious about protecting their wealth needs to understand the other side of this picture. Physical metal comes with its own set of risks, and ignoring them would be just as dangerous as ignoring the risks that led to the recent wallet disaster. The most obvious risk is what can be called single-party risk. Unlike a bank account backed by an institution, physical metal that someone holds personally is their responsibility alone. If it is lost, stolen, or destroyed in a fire or flood, there's often no one to reimburse that loss. This means the way metal is stored matters enormously. Many people choose a combination of solutions: a home safe for smaller amounts, a bank safe deposit box for added protection, or allocated storage through a reputable third-party vault for larger holdings. Each option comes with its own trade-offs between accessibility and security. There's also the issue of counterfeiting. As gold and silver have grown in popularity, so have fake versions of both. This makes it essential for buyers to learn how to recognize genuine metal and understand simple testing methods. Some investors use tools that test the sound a coin makes when tapped, since real metal often has a distinct tone. Others use magnetic testing methods, since genuine gold and silver behave differently around magnets compared to many counterfeit materials. These tools are inexpensive and widely available, and learning to use them is a smart step for anyone building a physical position. Beyond storage and authenticity, there is also the reality of premiums and liquidity. When someone buys physical gold or silver, they typically pay a small amount above the spot price, and when they sell, they may not always receive full spot price in return. Over short periods, this cost can feel frustrating. But when looked at across a longer stretch of time, gold and silver have consistently preserved purchasing power in a way that paper currency simply has not, especially as central banks continue printing money at a pace that steadily reduces the value of every dollar sitting in a savings account. This is really the core lesson from everything that has happened. No single asset is perfect. Bitcoin carries digital risk that can hide silently for years before surfacing all at once. Physical metal carries different risks tied to storage, authenticity, and liquidity. The smartest approach is not choosing one and ignoring the other, but understanding both clearly and building a strategy that spreads risk across different types of assets. In a world where even the most trusted digital systems can fail without warning, having a portion of wealth in something that cannot be hacked, drained, or erased by a hidden line of code offers a level of peace of mind that is becoming harder and harder to find anywhere else.